Beyond Markets, brought to you by First Bank. Truly the first.
Welcome back. Investing in emerging economies is challenging. We all know that. But if done right, it's a way of making significant money whilst also making a direct and profound difference to the lives of ordinary people. That's the view of private equity investor William Jimerson, who's the founder of Mercer Capital. He joins us now to talk about the so-called missing middle. Thanks so much for your time, Will. The general view is that with crises unfolding in the US and Europe, investors would be looking for yields in emerging markets. Certainly that was the trend in 2010. Do investors still feel this way, and how much of that money is coming to Africa?
I think absolutely the increasing appetite for African investment as a primary destination for diversification purposes is at an all-time high. We've been doing business on the continent for over 20 years now, and as we heard from your earlier guest, to have a firm like R&B actually put resources together to focus on an Africa report is indicative of the opportunity up continent.
I mean, the reason I'm asking you this is because we're told that private equity flows have increased above $2 billion or so per annum, but the concentration tended to be North Africa and not Sub-Saharan Africa. Is that changing? It
continues to be the case. Looking alone at South Africa, there's currently about 97 billion rand under management in private equity in South Africa. About 31 billion of that is still what we call dry powder or available to invest. That's South Africa. If you exclude North Africa, Egypt, and so forth, maybe a tenth of that number is available for the rest of the continent. You look at economies like Nigeria with a population over 150 million people, you wonder to yourself, is the need being met from the amount of liquidity in the market that's there now? And the answer is no, absolutely, which is an opportunity.
Now, private equity tends to focus on deals that are above 50 million, but we keep on hearing that actually the focus for Africa needs to be investment in SMEs. In fact, a report came out in Ghana that, despite Tullows listing and that boosting market capitalization, the only thing that will make that exchange dynamic is if SMEs list. But it seems to be the one area where investors fear to tread. Why is that?
It is the highest area of risk for investment. I mean, one out of every 7 businesses that start end up making it to be a mid-cap business and then going on to be a large cap. So there's a tremendous amount of startup risk related to that local operation to get it right early on, which it requires a very specialized investment skill that isn't necessarily as prevalent on the continent as it is in some other markets. To date, private equity remains a dominant asset class, primarily by the U.S. Globally, last year, about $55 billion was raised in the United States for private equity. In Africa, $1 billion. So to give you some context of not only the lack of capital that's available, but also the lack of skill set.
Okay, so Musa, you're prepared to go where others fear to tread, and that's within the mid-cap, not quite small, but somewhere medium enterprises. Why is that?
That's where the opportunity is. As the statistics that we just discussed, the question we often are asked as private equity fund managers, I'll be asked this if I work for Braid or an Ethos or for KKR or Blackstone, is where do you find transactions? Where's your source of deal flow? And more often than not, in the United States, you find cases where you have a large amount of capital chasing a very small pool of investment opportunities, driving up valuations, et cetera. Why do we go where we go into the mid-cap space? Is because often we are the only source of capital available. What is interesting about our model is that we go in early, not to be by ourselves, but to lay the groundwork for other institutional investors to come at a later stage.
I mean, you mentioned the pervasive risks of starting a business from scratch. The big challenge is the value add and when you register a return on that investment. How do you bridge that gap?
Well, it is absolutely that, Loretta. It's bridging the gap. We'll invest in a company that's, say, doing $10 to $12 million in top line. Often these companies are unable to access growth and expansion capital because the banks aren't designed to lend to companies that size. They're designed to be tailored to the large cap corporates. So our investment philosophy is to add value not just by adding capital to that business, but also adding ESG, or environmental, social, and governance. And that governance that can be applied to a large cap company can also be applied to a small and mid cap company, driving value, creating an opportunity and a platform for further growth down the road.
many experts say the only way to add value, particularly within a short space of time, is all the capex that you do and then list it and recover the costs. Is listing the option for you?
I disagree. I think the opportunity in the mid-cap space is growth, right? If you buy a transaction that's trading at a $10 million in EBITDA, and you grow that to $20 to $30 million in EBITDA, dividends alone gives you a 3 times return on your money. So while listing is a viable option for some companies, we've gone through listings in the past for some of our private equity investments, but by and large, it's liquidity generated by earning cash. As my college professor used to say, cash is king. So companies that can do that and can generate that capital, that cash flow, can be beneficial to investors.
Your strategy, because the traditional private equity strategy is come in, acquire an asset, give it value, be listed, but you've got to have exited within 5 years. Those returns must be seen. Are you here for the long haul? Do you play in that 5-year exit space?
We have to be. Africa, we believe, requires a different investment model than quote-unquote traditional LBO investing that most of our counterparts would experience in the States and Europe. The ability to exit in 5 years is a function of the capital markets. As we heard earlier by one of your guests, capital markets is reasonably limited in Africa, primarily to Egypt and South Africa and Nigeria, and somewhat Kenya in the east. So we have to look at opportunities to be there for the long term, and that may be 7 to 12 years. However, what we do is we drive value creation early. We drive liquidity early. So our current fund, which is fund number 2, we're seeing dividend yields off of that fund within the first 18 months of investing. Why? Because we look to prove the investment thesis to our limited partners, to our investors, by returning cash. And that drives the value early, and it maintains the value for the long term.
The areas where you invest, because as I said earlier on, you know, the hot money goes towards resources and commodities, maybe some retail elements. But you've got to go off the beaten track, so where do you go? Absolutely.
We believe consumer-facing industries. That's generally believed to be retail, but as an example, if a new copper mine is being developed in Zambia, that may be a $1 billion capital-intensive project. We don't have the balance sheet to participate in that type of project meaningfully. However, that mining company needs food for its employees. It needs housing for its employees. Matter of fact, they need roads and petrol and so forth. And when the copper is pulled out of the ground to be delivered to the DRC for processing, someone has to transport it. Those are the mid-cap companies that we look to support in the long term.
And finally, I don't want to use the word morality, but underscore. There is a sense that, you know, doing business in Africa has to think about the broader developmental gains for the communities that they're involved in. And hence the whole idea of social entrepreneurships. Make money, but make it in areas that will help develop the communities in whatever way. What are your views? Because this is where SMEs are also being urged to participate, is run a business that would help develop education or healthcare or something like that.
It's fundamental. It's not just a good tagline. It's fundamental for investors in this particular space to sustain a model that will be there for our children. And so I'm not investing to extract value for my current limited partners, my current investors. I'm extracting value today, but creating value for tomorrow. So education is a key driver throughout our investment philosophy. We don't have any investments directly in educational institutions, but each one of our portfolio companies has a ground training program to increase not only the educational base of the employees of that company, but also the children and the communities that we serve as well. It's fundamental as part of the investment thesis.
Well, it's been great having you. That's Will Jimison. He's the founder of Mosa Capital, talking to us about just the changing role and face of private equity in Africa. Now, in celebration of Women's Month, because it is Women's Month here in South Africa, ABN Events and Sanlam do invite you to a luncheon to be held at Swallow Waterfall. That's going to be Monday, the 22nd of August. There'll be a panel of incredible women who will share their successful stories and insights. Join the chairperson of African Fashion International, Dr. Precious Moloi Motsepe, the managing director of Estee Lauder Companies, Sue Fox, and many more. Seats are limited, so make sure you book yours at www.abndigital.com. Right, that's where we leave it for Beyond Markets. Thanks so much for your time. Do stay tuned to CNBC Africa. We're first in business worldwide.